Well, good morning, everybody. My name is Carl Frank with ANI Financial Services. Thank you so much for joining us for today's webinar. We've got a special guest, Bob Schmidt, today. He's going to talk about how we train the investor brain. I think you're going to enjoy it. We heard Bob many years ago, and we heard him several times. I think you'll find him engaging, humorous, and very informative. Let me give you a little bit of Bob's bio. I'm going to flip to the next slide and show you the disclosures as well, just so we can stay in good stead with our regulators. Let me tell you about Bob, and then I'm going to hand everything over to our speaker today. Bob Schmidt directs the operations for the Brandeis Institute. The Institute is the think tank division of the San Diego-based investment firm Brandeis Investment Advisors. You may have money invested with Brandeis. They are one of our best partners. In addition to overseeing the Institute, Bob also teaches part-time in the Master of Finance and Master of Accounting program at the Rady School of Management at the University of California in San Diego. Outside of work, Bob enjoys traveling. He's visited Colorado several times. Among Bob's favorite memories is seeing the no fishing sign on the Royal Gorge. Duh. He also enjoys music, working out, and is an avid sports fan, especially for teams from Philadelphia, close to where he grew up. Bob has a BA degree from the University of Duquesne and in Pittsburgh, and an MA from California State University, San Marcos. So Bob has more than 30 years of experience in our industry. I'm sure you're going to find him engaging and fun and informative. Without further ado, Bob Schmidt.
Okay. Carl, thanks so much. Stacy, thank you. And a thank you to everybody for joining us today. Yeah, we're going to talk about behavioral finance. This is one of my favorite topics. It's really the science of decision-making applied to investment decisions. So a lot of the things that I'll touch on, you could apply to almost any decision you make, but I'll bend the narrative around to focus on investing. We've got a lot of ground to cover. And what I really want to do is just highlight some of the behavioral missteps or mistakes that we all make. We all tend to make these mistakes at times. And I think if we can raise our awareness of them, we can address them, we can focus on them, and we can correct them, and hopefully make ourselves better, more rational, maybe more longer-term focused investors, and increase the likelihood of getting to our end goal. So that's a lot of ground to cover in about a half an hour or so. I want to start with a little fun. Even if you've seen this before, feel free to play along. We've got a checkerboard here with two squares lettered, squares A and B here and here, and a simple but deceptive question: are A and B different shades of gray? And I'm not talking about the letters here. I'm talking about the actual shade of these squares. Is A different from B? Now, some of you might be looking at this and asking, why is he even asking that question? I can see that they're different. I can see A is darker than B, but are you sure? So right now, the only tool that you have to make that distinction is your eyesight. And I'm going to help you out a little bit in just a second and remove all of the other squares, remove the cylinder, remove that shadow. And I'll show you something that may be a little surprising. A and B are in fact the same shade of gray. They're not different. They certainly look different in this slide, but they are in fact the same shade of gray. Now, if I were there in person, I would give each of you this handout, which contains the same picture, the same illustration, with one important difference. Squares A and B on this handout are little stickers that you can peel off. And I would ask you to do this, but since I can't be there in person, I'm going to do it myself. This might be the magic show portion of today's seminar, but I'm just going to peel off A, nothing up my sleeve here, put that in the margin, and then peel off B and put that in the margin next to it. And when I do that, you can see, in fact, that they are indeed the same shade of gray. If you didn't believe me showing you this. Now, I love to use this as an example to start a discussion about behavioral finance. And some of you may be sitting back going, yeah, that's interesting, but what in the world does that have to do with investing? Well, it has more to do with how we make decisions than investing. And it shows something very powerful called a heuristic. So our brain is really good at coming up with plausible solutions, even to complex problems, very quickly. but quickly doesn't always mean accurately. And we see that a lot in investing, particularly now when the markets have been so volatile. We may get emotional about things. We may want to jump to a conclusion when we think something kind of feels right. So I'll talk a lot more about that in a moment. I want to take a step back just for a second, talk a little bit about this institute, the think tank that I manage. I am not going to go through every element on this slide. I just want to focus on a couple things. I've been managing this think tank for 20 years. We're celebrating our 20-year anniversary this year. Over here, we talk about partnering with the investment community. Everything that we've done in 20 years has been done in collaboration with others, whether that's academics, whether it's plan sponsors, other investment managers, consultants. And the work that we've done has been featured in a bunch of different places. Down here, this research with Reach. You can see our work has been featured in the Wall Street Journal, Barron's, the Financial Times, CNBC, and also in academic journals, such as the Journal of Behavioral Finance. So we always want to ground what we're doing in academic rigor and make it practical. And I think that's why our work has been picked up both on the academic side and more of these popular places as well. So let's jump back in and let's talk a little bit about why our brains may have jumped to that conclusion and assumed that those squares were different colored grays when in fact they were the same shade. Researchers have looked at this and this notion of heuristics. Well, where does this come from? Well, this is a gross oversimplification, but researchers say there's two pathways in our brains in terms of how we make decisions. One is system one, our subcortex. And as you can see on screen, this is the fast thinking. This is the part of our brain that operates with little or no effort. If you understand the language and I pose a question, your brain will often form an answer to that question very quickly. That's not the part of our brain that we want to use when we're making investment decisions. We want to use system two, the prefrontal cortex. This is far more analytical thinking, effortful, agency, as it says on the screen here. If you were going to cheat on your taxes, and I know nobody's going to do that, including me, but this is the part of your brain that you would use. Now, this system one and system two thinking was chronicled in this terrific book, Thinking Fast and Slow by Danny Kahneman. I'll talk more about Kahneman later in this presentation, but he's a psychologist who won a Nobel Prize in economics. And we'll hit on his Nobel Prize winning theory in a moment. But just understanding how we make decisions, I think, is vital to improving our investment decisions. Now, this slide is designed to be almost impossible to read. All of those bullet points on the inner circle are different biases that researchers have chronicled over the last 20 or 30 years. There's over 200 on this slide. I don't have time to go through 200 today. I'm going to hit what I think are the most insidious, maybe the most dangerous ones in today's environment. So let's talk a little bit about something called recency bias, also known as availability bias. This is basically our tendency to overestimate the frequency or severity of an event based upon recent exposure. So a couple examples. I'll throw up these icons here of a shark and a plane crash and your bathtub. Now, our odds of dying in a shark attack are about 1 in 7 million. And honestly, I think the odds are even lower in Colorado. Our odds of dying in a plane crash, 1 in 11 million. And I put the bathtub up there because our odds of dying from a fall or complications related to a fall are about 1 in 130. And according to the CDC, 2/3 of falls in the home occur in the tub or shower. So statistically, getting into the tub is far more dangerous than getting on a plane or going in the ocean. But we don't tend to think of that because of this thing called recency bias. And this is where the media plays such a huge role in how we perceive the world. If there is a shark attack, if there is a plane crash, that news typically is all over the internet. It's all over cable TV news, blog sites, et cetera, et cetera. And we tend to think that these things happen more frequently than they actually do. And I don't want to minimize the tragedy of a plane crash. I only use that as an example of something that we've all seen, we've all heard of it. And again, we think it happens more often than it actually does. And again, this is where we want to engage system 2. So how does this apply to investing? Well, I went back a couple of years. We're coming up roughly on the 2-year anniversary of the pandemic outbreak, the devastating impact that it had on the markets at the time. And I pulled some headlines from what I think are fairly reputable financial news sources, the Globe and Mail in Canada, the Financial Times, the Journal, et cetera. And I'm not going to read the headlines. You can skim through them for yourself, but you see just how conflicting the reporting is even over a couple of days. And not surprisingly, the financial press plays primarily on 2 emotions, fear and greed. And I think it's vital if we're going to talk about behavioral biases, if we're going to talk about how our emotions can mislead us when investing, to talk about the financial press. And keep in mind, the financial press is not designed to inform you. They're designed to get you to tune back in, to go back to that website, not even the next day, but a couple hours later, a couple minutes later. There's always something that's breaking. There's always news that's happening. And it's always fascinating to me. You watch the news and these people will tell you this is a great stock to buy. This is a great sector to be in. This is a great fund to invest in. And they know nothing about you. They know nothing about your long-term plans, your net worth, your tax situation, your risk tolerance, all vital aspects to creating a good long-term plan and sticking with it. So be very, very wary of the financial press, especially at times like this when we have market volatility. So I want to talk a little bit next about Ben Graham. Ben Graham doesn't get the attention, the recognition that he deserves, but he's really the father of value investing and the father of behavioral finance. This is a guy who started on Wall Street in 1918, and he was a mentor, a teacher to Warren Buffett. And a lot of people today think Warren Buffett is one of the greatest investors ever. Buffett has said Ben Graham was the best investor he knew. And I love this quote. This is Buffett talking about Graham saying, in the short run, the market is a voting machine, but in the long run, the market is a weighing machine. And what I think Graham meant by that, in the short run, we're so focused on price. But in the long term, it's the value of asset classes that win out. And a lot of times with these behavioral biases, they influence our short-term behavior, and you're going to see these fluctuations in price, and I'll talk more about that in a moment. But over the long haul, markets tend to go up, and it's really the value of either the underlying securities or the assets that are driving that increase in value. The last point I'd make on this slide, system 1, that emotional thinking, that gut level reaction, is obsessed with price. System 2 is far more focused on the value. So again, we don't want to make these system 1 emotional decisions that are really price driven. And I think, again, if we're aware of that, we're better positioned to take a step back when emotion starts to crowd our thinking and be a little more long-term focused, a little more rational. So next, let's take a look at something called framing. And this is simply our perception of things is often influenced by either how we choose to see something or how information is presented to us. And I use the classic example here of the glass being half full, or is it half empty? And if I showed you just the 2 glasses on the left, this one completely empty, you might look at this and say, well, it's half full. But relative to the glass on the far right that's full, you might say, well, this one's half empty. And the key point I want to make here, that glass in the middle, is it half full or is it half empty? It's actually both. Again, it's just how we choose to look at it or how the information is presented to us. So let's look at an investing example of this. If I shared this with you, here's a chart that shows S&P 500 index calendar returns 1928 to 2021. And you can see the annual returns are kind of all over the chart. There's a lot of them that are above zero. There's a bunch of them that are below zero. And if you looked at this and I said, does this look like a good investment? You might look at that and say, I'm not quite sure. No, again, a lot of dots above zero, a lot of dots below zero. It looks kind of like a 50-50 investment. But actually over that time period, the S&P 500 was up annualized about 11% a year. This would have been a phenomenal investment. But here I'm framing it in terms of gains on the upside and losses below zero. Next, I'm going to take the same data, the very same data, and I'm just going to show it to you in a different way. I'm going to try and frame it in terms largely of gains and show you the growth of a $100 investment over the same time period. I'm telling you again, the exact same data as this slide we used in this slide. But if I showed you this and said, do you want to invest in this? You might say, yes, I want this one. I don't want that one. This is the one I want. It's the same data, okay? Here, again, we're just framing it largely in terms of gains. And we're using, I'm getting a little bit in the weeds here, we're using a log scale on the left side. So it's in increments or multiples of 10, 100 to 1,000 to 10,000, et cetera. But the key point I want to make with this one, it's actually both. Yes, it's gone up quite a bit over that time frame, but there's periods where you've had sharp declines along the way. You know, here in 99, again, 2007, back here, of course, in 1929. So as we're in the midst of the market's gyrations, it's hard to see both the short-term losses and the long-term gains. Here, I'm trying to frame both for you, again, with the goal of keeping us focused on the long term. And again, I think this is so relevant today, given the volatility that we've seen since Russia invaded, but it's very similar to periods of volatility that we've seen before. There's a lot going on in this slide, but on the left side here, what I'm showing are the 10 worst performing days in the S&P 500 going back to 1940, and over here, the 10 best performing days. And what I tried to do here was use some colors to show how these worst performing days and the best performing days tend to cluster. You see this back 2 years ago, where you had these days of down 9%, down 12%, down 8%. Right around the same time, the market was up 7, 9, and 9%. The same thing back in the great financial crisis, 2008, 2009. And we're seeing this today. I think it was either earlier this week, yesterday, or I think it was last week, the German stock market was up almost 8% in one day. So basically, you're getting a year's worth of gains in a single day. And the key point I want to stress here is during periods of market volatility, sometimes that system one thinking will kick in and we say, ooh, I should get out of the market before one of these bad performing days and get back in ahead of one of these better performing days. And my advice is don't try that. You know, that is market timing. We don't want to do that. And we definitely don't want to do that during periods of volatility. And the only thing that I can share with you, and this may not be very helpful, I'm just being honest, historically, when we've had periods of high volatility in the market, they continue right up until they stop. And I don't know when that's going to happen. And nobody does. So be very wary of somebody who says, oh, I can tell you, I know what the market's going to do tomorrow. No, they really don't. They can guess at it, but day to day, it's largely noise. So my best advice is to stay invested, stay focused on the long term. And we're seeing more of that today. There's less examples today versus 15, 20 years ago of people trying to time the market. Because this is what happens, right? We all know about extrapolation. We think what's happening now is going to continue out into the future. And markets tend to be mean reverting, meaning, again, they tend to go up over the long term, but you've got these ups and downs along the way. And with extrapolation in mind, this is what we want to avoid. We want to avoid getting greedy and buying at the peaks and selling when the market is at its low. And as you can see here, if we repeat that process, then we'll become broke, okay? It's an old adage, right? You want to buy low and sell high. And it's super simple. but it's not easy. And it's often not easy because our emotions get in the way. So earlier, I mentioned Danny Kahneman, this psychologist who won the Nobel Prize in economics several years ago. And he won for something called prospect theory. And I think this is really important to revisit, especially given what's happened in the markets the last couple of weeks. In short, Kahneman argued that losses in the market hurt twice as much, at least twice as much, as comparable gains feel good. Losses hurt at least twice as much as comparable gains feel good. And that's what we tried to show here with this formula, fear equals 2 times greed, or with this asymmetrical sloping line. Here on the losses side, you can see how that line goes down really sharply. And on the positive side, it's a little more flat. So a couple examples here. If you lost $100,000 in the market, okay, you would feel really bad. But if you got that $100,000 back, you would be even, but you probably wouldn't feel even. You'd still feel like you lost money. That's how prospect theory explains our emotional reaction to losing money. Now, when I first read this, I thought, this is really interesting, but how do you quantify this? This is like me saying, I love my dog, twice as much as this guy loves his dog. How do you quantify that? Kahneman and his research partner, Amos Tversky, did tons of experiments with money. And basically they were trying to quantify their emotions. And what they did, I'll just share this one. I think it's fascinating. They brought people together in a room and they said, we're going to play a game. And in this game, it consists of 20 rounds. Every round, a moderator, somebody like me, is going to toss a coin. And if it comes up heads, you'll get $2, I think it was $2.50 back on a dollar that you bet. So if it comes up heads, you get $2.50. If it comes up tails, you're going to lose $1. So 20 rounds, people were given $20. You can bet $1 a round. $2.50. If it ends up heads, you lose your dollar. If the coin comes up tails. If you figure out the probabilities, it makes most sense to play every round because your upside is 2.5 and your downside is only 1. But that's not what people did. They played and then they lost. They lost $1. They lost $1. And then they sat out for a few rounds and they watched other people winning and then they wanted to get back in. Now, they use that 2.5 to help quantify how much money would it take to get people to bet in the first place. And to me, that little simulation sounds exactly like stock market, bond market, real estate market. People want to get in when they're winning. People want to get in when prices are going up. And they want to get out, sometimes all the way out, when they lose a little money. But again, that is very, very short-term focused. And it really impacts your long-term wealth generating potential. So that's prospect theory. Let's put it into practice, okay? We'll look at a hypothetical portfolio that goes up consistently over 20 years. And when I say consistently, I mean 15% a year, has a very low standard deviation of 10%. All that means is 2/3 of the time, this portfolio is going to return between 5% and 25%. So an average of 15%. This is a phenomenal portfolio. I don't think Bernie Madoff had returns this good. But we've got two couples here, the Folgers and the Rogers. They've got the same amount of money invested in the same portfolio over the same time period. The Folgers, they're thrilled. The Rogers, far less so. The difference between the couples, it's not their hairdressers, by the way. One, I'm so jealous of these people. They all have full heads of hair. But I've used this slide in the past and people said, well, the Folgers are obviously younger. We might have to revise this. We're trying to show them both the same age. The difference between the two, again, same portfolio, might be how frequently they look at returns. And that's what we were trying to show with the laptop computer. Now, remember what I said about prospect theory, okay? If you see a paper gain, it doesn't have to be realized. You just log into your account and you see it going up, That's like getting one positive emotional unit. But if you see a loss, it's like getting two negative emotional units. And even with this phenomenal account, if the returns are normally distributed, so they follow a bell-shaped curve, you would see a gain roughly half the time if you looked at it every day, every hour, every minute, or every second, which means the other half of the time, you're going to see a loss and you're going to feel twice as bad as that gain makes you feel good. That's dangerous. Now, looking at your account every second, every minute, every hour, of course, nobody does that, right? We don't have cell phones. We don't have computers. In making or increasing transparency with investing, I also think that technology has made it a heck of a lot harder to avoid some of these behavioral biases and these behavioral tendencies. But as you can see with the stats, if you can hold off and look at it once a month, you increase the chances of seeing a gain. And those probabilities go much higher if you looked at it just once a year. Now, I'm not naive enough to think you're only going to look at your account balance once a year. I just want to point out the dangers of looking at it frequently, because emotionally it weighs on us, even if we see a small loss. So with these statistics in mind, we created a tool called the Wheel of Investor Emotion. And it's simply, we have a bunch of these. If you want one, we can have them sent out to you. We've got an online version too. We can send you the link. But basically, it uses the same statistics that I just shared. And if you look at it every day, 54% chance of seeing a gain. And then we put these little emojis in here. Now, this guy looks really nervous or like he's got to go to the bathroom. But if you can hold off and look at it once a year, the probability of seeing a gain goes up to 93%. And then the emoji is like a 100-watt smile. Honestly, when we created this thing, I thought it was kind of hokey. I thought nobody is going to use this. I was dead wrong. This has easily been the most popular tool that we've created. And it's really been helpful for people to see the impact of looking at their account so frequently. And it's just, again, another tool trying to get us to focus more on the long term. And now I want to talk a little bit more about that with this paper that we've got at our website called Redefining Risk and Return, written by these two academics, Dr. Eben Atute and Mohammed Siddiqui. 17-page paper. I'll sum it up for you here in a couple sentences. These two professors argued that volatility, that price volatility, is not synonymous with risk. We tend to think of volatility as risk. These guys argued that's not really true. And if you look at the box there, volatility with any asset class is not a surprise. They're arguing it's neutral. It's just part of what an asset is. And again, that could be if you're trading currencies, commodities, real estate, stocks, bonds, options, doesn't matter. Price volatility, you know there's going to be price volatility when you invest in almost anything. They're saying you can turn that volatility into risk if you mishandle it. And I think they're spot on. And it's one of the key points that I'm trying to stress in this session today. That price fluctuation, we know that's going to trigger our emotions. We know we may want to act impulsively on those emotions, and yet we can't do that. The thing that I've seen over my 30 years that really derails great long-term plans is a short-term emotional reaction. So this is their theory. And then I was wondering, okay, how do we put this into practice? So here's a slide that shows risk on the bottom, on the x-axis here, and we've got return on the y-axis. And I'm arguing, if I shared this with you and I asked, what's the relationship between risk and return? Can you draw it for me on this blank graph? Most people, given what they've heard, what they've learned about risk and return, would probably draw a straight line that slopes up from left to right, suggesting the more risk that I take, the more return I get. The more risk I take, the more return I get. And that is classic System 1 thinking. Engage system 2 for a second. If we always were rewarded with more return for taking more risk, it wouldn't be risky. We just load up on these risky assets and make money hand over fist. There's a far more nuanced relationship between risk and return. And this is the theory here, right? A low risk investment, the range of potential returns is pretty tight. So think about your savings account or CDs, pretty tight return. And you're not going to lose money. This thing is FDIC insured. There's really no risk of loss. As we take on more risk, our potential for return goes up, but the potential for loss also increases. So with a high risk investment, right, you might make multiples of your initial investment, or if it's really high risk, you might lose it all. So again, I think this is a more system 2 way to think about that relationship between risk or price volatility and return. This is the theory. And then I wanted to put this into practice. So if we put it in practice and we add an important element, namely time, it literally turns this graph upside down. And this is the range of returns for US stocks over various rolling periods. So over rolling 2-year periods, going back to 1926, so 26 to 28, 27 to 29, et cetera, here's the range of returns. Could be as high as almost 50% annualized and as low as negative 50% annualized over 2-year periods. But if we look at the same range of returns over 5-year periods, it gets tighter. And the likelihood of seeing a gain goes up. Tighter again at the 10-year level, 20 years, and 30 years. So again, literally turns that last slide upside down. So in the short term, the potential to have great returns on the upside, yes, but you could have some years where the stock market is down big, okay? The longer you're invested, the more you're putting time to work for you. You've probably heard that phrase, right? It's not timing the market, which I talked about before. It's time in the market. So when I share this with people, I think it's a great illustration of how history has shown us in the short term, we should expect price fluctuations. We did the same thing with bonds, by the way. We used, I still want to call it the Lehman Ag. It's now what the Barclays or the Bloomberg Aggregate Index. You see the same pattern in returns. You just see tighter bands. So it's a little tighter for bonds, but the same pattern. So when these short-term periods happen and stock prices or bond prices go down, we tend to get emotional, but this is a natural part of investing. It shouldn't freak us out, yet it tends to every time it happens. So again, I just share this as another way to stay focused on the long term and be less emotional, particularly in the short term. So to cap this off, I would just suggest asking yourself a simple question. What do you think the stock market, and you can say the S&P 500, the Dow, NASDAQ, whatever, what do you expect returns to be for the next year? Give me a range of outcomes, a range, okay? I don't want one number, I want a range. Now, having given this presentation all over the world, people generally will come back and say, well, you told me earlier that the S&P returned like 11% annualized since 1926. So if you want a range of returns, I'd say maybe 5% to 15%. And somebody else might say, well, yes, but now there's all these threats, right? We have the threat of inflation. We literally have war in Europe. There's supply chain disruptions. There's still COVID out there. It's even worse in other parts of the world. So my range of returns is going to be more in the 3 to 6% range. And what I'm listening for, what I hope people include, is a negative number in the range. Remember, I showed you just a couple slides ago that over history, we've had periods over a 2-year stretch where annualized, the market fell like 40%. Okay. We could have a year where the stock market loses money. And we know that's going to weigh on us given prospect theory. But over the long term, we tend to be in good shape. So just remember that as we're going through some of these short-term price fluctuations and trying to reorient yourself on the long term. And the last thing I want to touch on here is just the importance, I think, of a good process. What we can control when we're investing is our asset allocation, how we're investing. And we tend to focus on the outcome. We tend to focus on the results. So we have a good process, we've built a thoughtful portfolio, and we have a good outcome. That's high five, deserves success. But you can have a good process. You can have a great portfolio and still have a bad outcome, especially in the short term. That's just a bad break. And that's part of long-term investing. But we want to caution against having a bad process. And I'd argue a bad process is short-term oriented. We're trying to react to every twist and turn in the market. We're chasing fads. We're not thinking about price relative to value. Even if you did all those things wrong, you could still have a good outcome. And it's similar to me, if anybody plays blackjack, right? You're sitting at the table and the dealer is showing, 5, and the guy next to you has 18. And he says, hit me. Like, dude, dealer has 5, you have 18, hit me. That's a terrible process, but he draws what? A 3, 21, and he wins the hand, okay? Bad process, good outcome. I'd argue that's not good luck, that's dumb luck. And if you continue to play like that, if you continue to invest like that, you're not going to have a lot of money very long. So a bad process and a bad outcome is poetic justice. So again, let's focus on what we can control. And in closing, I would just encourage you, try to understand how we're making investment decisions. Am I being thoughtful? Am I being rational? Am I investing in line with my long-term investment goals? And then hopefully I can stomach some of this short-term volatility. And then be aware of some of the tools that we've created, whether it's the checkerboards, the wheel of investor emotion, and just reorienting yourself to your specific long-term goals. Think long-term, and then always, always, always ask for help. Seek additional resources, whether that's ANI, whether that's the Institute. We're here for you to help you get where you want to go. So with that, Carl, I'll close and we can open it up to any questions.
Bob, thank you so much. That was great. I really appreciate it. It's so good to have that insight again. I view a lot of the advice you're giving us as more than just good investment advice, but very good business advice for managing a business and anything that requires any rational activity in life. I think there's a lot of truth in all of these things that Danny Kahneman and you even had Nassim Taleb on there. Oh my gosh, a lot of great stuff. Yeah. People on the call, if you'd like to ask a question, what we did to make it easier for everybody was turn off everybody's cameras and voices, but you can chat. So if you see the bottom of your screen, you can see a little chat window there, and just click the chat and you can go ahead and enter a question for us. So if you have anything, please go ahead and do that. Bob, I'm going to get us started and just ask kind of a general question. You did a great job of explaining System 1 and System 2. I don't think that's intuitive to a lot of people. I think it's hard to think that our brain is, and you drew a great picture of dividing the brain in half, the front and the back, the slow and the fast. But I got to be fair. I mean, you kind of beat up on the fast thinking. So if it can't all be bad, right? There's got to be something good about having a fast-thinking brain, isn't there?
Yes. Yeah, it's a great question. So yes, our fast-thinking, our System 1 brain definitely helps us day to day. If you're driving on the freeway and somebody is cutting you off, right? You're not going to sit there and say, oh, this person is kind of encroaching in my space. And if I continue with this pace, I probably will hit that person. So what do I want to do? Do I want to honk the horn? Do I want to step on the brake? It's this quick reaction. So that there's another example. I'll probably screw up the statistics on it, but something like if you were getting dressed in the morning and you looked in your closet and you had like 10 shirts and 10 jackets and 4 belts and 10 pairs of pants and 10 socks and 5 pairs of shoes, you could create like 2 million combinations of outfits. And if you evaluated each one for 1 second, it would take you like 2 weeks to get dressed. And some of you might be saying, well, I've got teenage daughters or teenage granddaughters, I know how long it's going to take them to get dressed. But my point is, we don't do that. This will work. I'll take the blue shirt. I'll take this, and off we go. So yes, there's some definite utility in that system one thinking.
Yeah, the wardrobe has never been my problem. I get teased about it from my wife all the time. I don't know why. I'm a little boring. I guess I could have a different color vest. Let me ask you, and again, if you have any questions, folks in the audience, please hit it in the chat menu. It's the little speaking icon, like from a cartoon at the bottom in the center of the screen. I've got one about this wonderful and crazy idea of recency bias. And I think it's just so close to extrapolation.
Yes.
So what recently happened was we had inflation, right? And then all of a sudden we have a war in Ukraine. And so it seems like we're going to have these forever, right? I mean, it just recently happened. And so I'm going to extrapolate that what just recently happened is going to continue forever. And it's hard, I think, to control that, right? Our emotions so quickly get out of line. What can we do when that happens? I mean, it seems like there's got to be a way to just rationally calm down the system one and say, and yet, like you said, we're getting inundated from the news, which makes a lot of money by us feeling the fear. Any advice you can give there would be great.
Yeah, another great question, Carl. Just a couple things. I always think it's helpful to reorient with history because we're going through these times right now, and the circumstances are always different, right? We haven't had a pandemic, the supply chain issues, a war in Ukraine. We've never had that before, but we've had similar instances in the past. And I think about that long-term chart for stocks. You could show the same chart for bonds or real estate. And again, there are these periods where things feel uncertain, unsettled, but I'm a big mean reversion guy. Over the long haul, I want to be in wealth generating assets. And focusing on the long-term potential hopefully helps us ride out the short-term volatility. And it's again why I suggest using things like this tool and also partnering with a third-party professional. On our own, a lot of people, not all, but a lot of people don't have the mettle to get through this. Buffett talks about this quite a bit. He's like, you don't need to be the smartest guy or the smartest gal to make money. It's what's going on in here. So you have these questions, talk to Carl and the team, and hopefully get that rational third-party perspective that can calm you down a bit.
That is great advice. And it's so easier said than done, isn't it? I just want to be in the highest performing investment, right? And then all of a sudden it happens and you're like, oh my gosh, the metal, like you said.
Yeah.
We've got a great, go ahead.
Oh, no, sorry. I always think of some dumb joke. I think it was Mark Twain who said, it's easy to quit smoking. I've done it hundreds of times. It's so hard day to day to get through. And we recognize that. But again, I think raising our awareness of how hard it is, hopefully gives us insight on what needs to be done. And you don't want to have these emotional reactions in the short term.
Yeah, I love that quote. That's so true, isn't it? Oh my gosh. We've got a great question from the audience. Again, if anybody else has a question, go ahead and type it into the chat. We'll take as many as you like. I often think about our inundation with 24-hour news and social media, even investment news. So you think that all this is more system one instead of, say, research journalism that might be system two thinking?
Great question, and totally agree. And for somebody who studied journalism and worked as a newspaper reporter when I was in college, I'm horrified by what passes as news today. And not just the system one, system two reporting, because it's certainly more salacious. It's more clickbait, the headlines that are designed to get your attention, because it's so hard to get people's attention today. Cell phones, I think, are the in some ways the worst contributor to that. So yes, totally agree. And then what passes for news versus opinion, that line to me has been not blurred, but just completely crossed. And the whole notion, Trump made it famous with fake news, but there's a lot of misinformation. There's just a lot of bad stuff out there. And again, as having journalistic training, I was always taught you want to be really credible with your sources. And where is this information coming from? And then to present fairly both sides of the story. Now, you're going to slant a story a certain way, just like I slanted my presentation to talk about the long-term potential of different asset classes. So I'm also saying in the short term, you're going to see these losses. But yeah, I totally agree. And it's one more reason why I think it's so important to look at the news with not even a grain, like a huge dose of skepticism. And if you can, try and look at it not very frequently, because it really is designed to hook you in and keep you scrolling and keep you clicking on things just to get you to click on ads and all this stuff. So you have to be super, super wary of the media. Great question.
Well, you really do. And it seems like maybe that, back to my first question, maybe system one gives you a little bit of pleasure. Like maybe that, and maybe by engaging that part of our brain, all of this social media and everything else is tricking us into stopping thinking. Yes. And
I like that analogy of or explanation of there is some pleasure in that. And there's nothing wrong with that. That kind of reminds me of another comment that I would get after this presentation where people will say, well, okay, you just want me to be a robot. And I would say, when it comes to investing, and I'll be really, really candid here, the images, the video I've seen coming out of Ukraine are horrifying. And I can have an emotional reaction to that and simultaneously still have a rational reaction to how I'm investing. So yeah, if there's some pleasure in scrolling and Facebook and Instagram, terrific, but make sure you've got some guide rails, some guardrails on that, and make sure that doesn't spill over into how you think, how you act when you're investing.
There's a lot of wisdom there, and probably setting a timeout before you go ahead and hit respond to whatever it is that's lighting your fire.
Yes.
Is a good idea.
Yes.
It's a good idea, whether it's in investing or social media. Well, if you have any questions, here's your last chance before we let our expert go. I will have one more little comment, which is, and then I'll tell you about our next speakers. That our Expert Network Team podcast, you can find us Expert Network Team anywhere, discusses a really similar set of conversations about how we can reduce our stress and panic and other feelings that we're having right now. And some of the experts who I interviewed on that podcast had some great advice, not the least of which is to just completely, if it's causing you stress, get rid of it. Like, find a slower medium to get your news as opposed to the social media. And there's other great advice on there, so you may want to check out the podcast. Well, let me tell us about our next couple of presenters, and then I'm going to jump back to you for closing thoughts, Bob, if you're comfortable with that.
Yep.
Let me jump over here, and I'll make the screen really big. Okay, so I hope that's going to pop in there. There we go. So our next presenter is actually from the same company. Brandeis is a great firm that we invest with, and a wonderful person named Louis Lau, who was a Mandarin speaker. He was born and raised in Singapore, and is a brilliant person. He's going to simplify a lot of the complexities with China. He and I are going to interview each other, really, but I will be asking all the questions. He will be answering them, I hope, and I think you're going to find him engaging and informative. We arranged this before the whole Ukraine situation, and I think the China situation will outlive whatever happens with Russia and Ukraine. So it's a very timely topic. I really hope you enjoy it. You can join us. If not, we'll record it. This presentation will be recorded, so I hope you can share this with your friends. And then finally, I'll just leave it with this. If you want more information about anything that we talked about here today, check us out on the web. Talk to your financial advisor. We can send you those wonderful little circles and the link. We'll have that in next week's email. The next week's Periscope email. So a pleasure to engage with all of you today. Bob, any closing thoughts? The floor is yours.
Thanks, Carl. Not surprisingly, I just want to stress the importance of looking at price and value. I mean, Brandis, we're a long-only value investor. We've delivered great results over time. And our approach is the same as when you go to the supermarket. You're looking at how things are priced relative to what you think they're worth. And I was thinking about this morning, and I had to go back and look. It was in 2017, The Economist had a cover story about the bull market in everything. So if you think back just 4.5 years ago, stock markets were at record highs, bond markets are doing great because interest rates are coming down, real estate is surging, like everything was going gangbusters, and they were asking, where do you invest? And at the time, I was thinking, drive it back to the price I'm paying versus the value of this asset. And I think that's the same approach that I would have today. And it's very different today, where markets are retreating. The bond market is in upheaval, depending upon, I don't know, did the Fed make their announcement yet? Is it today or is it tomorrow? They're going to probably raise short-term rates.
This week.
Okay. So, there's a lot of uncertainty, but again, thinking about the price you pay relative to the value. And that's what Graham talked about. That's what Buffett talks about. So if that's houses, if it's bonds, if it's stocks, that I always think is a great approach. And those are the assets that we tend to focus on, like commodities. Everybody's talking about commodities right now because oil is going up, but it's so hard to really value a barrel of oil. What is a barrel of oil worth? Well, honestly, it's worth what somebody's willing to pay for it. So that is almost a price-only analysis that you're doing. So I would lean on asset classes where you can compare price and value and think long-term.
Excellent closing thoughts. Thank you so much for making it real. Bob, we really appreciate your time and expertise today. I enjoyed this thoroughly. I think that our audience probably did as well. And I look forward to seeing you again in the future.
Sounds good. Thank you.
Great, a beautiful day. Bye, everybody.